Hey everybody, it's Jeff. And in this video, I want to talk about a few things. One, where I think gold prices are going to go, but more importantly, what actually moves gold price. See, my main job is actually a commodity trader. I trade the paper markets. I focus on grain commodities, but I follow gold and really all the metals very closely on a regular basis. And I think there are a few things that actually the intelligent numismatist can really follow to help you decide whether now is a good time to buy or a good time to sell. And they're really not that difficult to follow. So let's dig right into it. Right off the bat, you see obviously this beautiful gold buffalo here. And the reason I bring it up, and this is APMEX website, and you can really find this on any of the major websites or even your local coin dealer. There's this thing called the cash market, which differs from the futures market, which is the paper market that people discuss. And this idea of the cash market is actual cash gold. If, as numismatists, when we go out and buy an ounce of gold, a half ounce or whatever, but specifically really an ounce of non-numismatic gold, such as the gold buffalo, is it trading at a premium to the futures market? And they have the gold price up here on APMEX website, $1,870 an ounce. And the cheapest you can buy is 2030. And you come and you say, okay, what's 2030 minus 1870? That's $160 an ounce over the futures price. And in all commodity markets, when the cash gold is selling for more than futures, that is a positive basis, is what they call it. But that's a positive market that represents a shortage of actual physical gold. And I've called around to all my local dealers asking if they had 1 ounce gold in, and any mid-size to small dealer doesn't have any gold in, and the big dealers have just a little bit. So there's a convolution of effects here. The prices are well above futures, and that's a telling sign. And the other big thing that's really driving the gold price right now is what's called the US dollar index. And this is essentially the world basket index. All currencies are based on the US dollar. And when this chart looks crazy, but when it goes up, it means the US dollar becomes more valuable compared to the world. And an easy way to think about it is actually us versus the euro, which is the major currency of the European countries. When we got all the way up here to a 103 index, you could take 1 US dollar and buy about 94 cents of a euro. Whereas today, $1 buys maybe 80 cents of a euro. So in other words, that same dollar is not going as far as it once did. In other words, because we're printing so much money, the value of the US dollar relative to other world currencies is definitely going down. And as this goes down, commodities based on US dollars, which gold is one of them, tends to become more valuable. All the grain commodities are going up. A lot of commodities everywhere, even crude's going up, despite it being fairly well supplied, simply because this dollar index is going down. So from there, it says, okay, well, what does the gold chart look like? And this gold chart goes all the way back to 2018. And you could see the trend is generally higher. And this simple look, even though it looks very busy, this idea that it's going from lower left to upper right, trends tend to continue in markets. Now, they go through periods of choppiness and frustration, but they tend to continue. And the paper traders, called the speculators, will watch those trends, and they'll see if trends like this could break to perhaps justify maybe the market is just not that healthy. And it's held on, and it's up to 1860 to 1870 an ounce, and it held on to a key area. So in my opinion, I think gold price will go higher. And then it goes down to the very last fact, and that is the actual speculator themselves. Now, this is going to look like a funny looking chart, but it's extremely important. If you ever really want to invest in gold in the long run, this single factor will help you decide, is it a good time to buy or a good time to sell, especially a good time to buy. The fund position, this managed money, is essentially the name that the CFTC gives the speculator. The CFTC is the governing body that monitors all commodity markets to make sure there's no wrongdoing. And if a speculator breaks the law, the CFTC is the governing body that will put them in jail. And because of the CFTC watching the market, they actually require any paper trader of gold to input their position every single week. So if they're long it, which means they make money when it goes up, or if they're betting prices or go down, which means they're short, they have to input those positions every week into the CFTC database, essentially showing their hand. And from there, the CFTC posts it publicly for anyone to see. And in this report, they show, for example, as of January 5th, right before we broke about a week and a half ago, speculators were long a combined 127,000 contracts of gold. Now, what does that mean? One contract of gold is 100 ounces. So 127,000 essentially is 12.7 million ounces of gold that they were betting that the price was going to go higher. Now, the unique thing about gold is the contract is rarely delivered upon. So it's not like these speculators are going to actually take 12.7 million ounces of gold. It just doesn't work that way. Rather, they're making a financial bet that the price is going to go higher. And they're making a pretty big bet. This is actually on the high end of history. So they're near peak long, which normally is a concern. However, all commodity markets right now are seeing the speculative position go way beyond record. And this is in line with actually where we were at the high. And as you can see, gold price is 1,950. Now, really what you want to see in the long run of when is the best time to buy? When they're short. And you'll see on the long side versus the short side. That's how you determine the net position. You take the long minus the short. And this, back in August 14th of 2018, gold was 1,180 an ounce, and speculators were short 84,000 contracts. Whenever they get short, the reason is you want to buy it then, because at some point they're going to have to cover that short, which means they're going to buy those contracts in, thereby push the price higher. So I know this was certainly a little bit higher level, but I wanted to peel back the veil a little bit and really explain what the paper traders do when they trade gold futures to hopefully make it a little less frustrating. And in the long run, I definitely think gold prices will trend higher, and it'll be driven a large part by the fact that the cash market is reflecting that it's much, much tighter than where the futures are. Whenever you see this relationship flip-flop, where you could see gold price at 1870 an ounce and APMEX is willing to sell you gold at less than that, that is a concern. We definitely are not seeing it right now, and I don't think we will for quite a while. So hopefully you appreciate this video, and if you do, please hit that like button, and I really appreciate anybody who's subscribing to my new channel. Take care.